and invest efficiently. So from the literature, we can find the overconfidence index for different countries, different overconfidence indices for different countries. So the hypothesis would be managers that are located in relatively more overconfident countries, they'll invest more, and the asset growth effect will be stronger. I'll go back to the hypothesis again in next slides. So the second one, the second important aspect is called the uncertainty over avoidance. So if managers are more uncertainty avoidance, they try to avoid uncertainty, the tendency is stronger try to avoid uncertainty, then they will mitigate over investment. That means they are more conservative, so they invest less. And it's actually good for the firm because managers are more risk averse, then the asset growth effect will be less or will be mitigated. So these two psychological dimensions would serve as proxy for the overinvestment hypothesis. So let me explain the hypothesis in more details. So the first one is called managerial overconfidence will enhance overinvestment. So the empirical findings that are consistent with this hypothesis would be the asset growth effect is going to be stronger in individualistic cultures because managers in more individualistic cultures will invest more. If they invest more, they tend to overinvest. If they overinvest, then the investment or asset growth will be negatively related to their future stock returns. So that's the first hypothesis. And the second one is that uncertainty avoidance will mitigate overinvestment because managers in more uncertainty avoidant countries will tend to invest less because they are more risk averse. If this is true, then the asset growth effect will be stronger in low uncertainty avoiding cultures. Or in other words, asset growth effect will be weaker in high uncertainty avoiding cultures because managers in uncertainty avoiding cultures tend to invest less, then the asset growth anomaly or asset growth effect will be weaker. Okay, and finally, we will show that the national culture factors are so strong they can subsume market development and other efficiency factors in explaining asset growth effect. So we show this by running various multiple regressions, and those regressions will show that our national culture factors are actually the strongest factors among all factors that have been proposed in the literature. So we'll use cross-sectional regressions to show that our hypotheses are stronger, or our factors are stronger, actually, right? So let me proceed to talk about the data and variable construction. We have a sample consisting of all common listed stocks from 41 countries around the world. And because due to data constraints, it's very difficult to include stocks from all countries because some countries, they just don't have enough data to be tested. So the 41 countries are almost the best we can do. So we have monthly market and accounting data for international markets obtained from data stream. And the US data will be obtained from CRISP and CompuStat. And let me talk about the US data first, because US data is the most complete data set. So the number of firms are the largest for US data. So one potential criticism is that the US result will dominate the international findings because the data set is just much larger than the other countries' common stock data set. So in later tests, we'll exclude the US data and show that our results still hold without with and without the US data. And we obtained the country level individualism, uncertainty, and avoidance indices from Hofstede 1980 and 2001, and supplemented by Hofstede and Minkoff 2010. And these two papers, well, actually, these three papers are the most commonly used in the literature, not just finance, also in management. When people, try to figure out the differences among national cultures that rely on the survey of these three papers. So these papers are commonly used in the relevant literature about national cultures. And because national cultures, they tend to be very stable, they don't change too much. So the survey, even though it's somewhat outdated, but still people use it because it's hard to believe that national cultures will change overnight. Okay. All right. This is the measurement of asset growth, and asset growth is simply measured as the total asset difference in total assets of two different periods divided by the total assets of previous period. And this is called total asset growth, right? And what has been found in the literature is that this total asset growth measure is negatively related to stock returns, okay? This is well established in the US and around the world. And so people try to figure out why when you invest more, then your future returns are actually lower. And we'll follow pharma and French closely in constructing variables such as firm size, book to market ratio, and we'll also use the past return as a proxy for momentum to be included in the pharma Macbeth regressions. So all returns are converted to US dollars because different countries have different currencies. But this will not affect our results materially because later on, we also use the local currency returns to reperform all of our tests, and the results are pretty similar. Okay, so let me see if I can share with you my paper. Just give me a second. Let me bring up my paper. Yeah. Okay. So this is the original paper. If you're interested, I can send you the paper after my talk. I would like to show you a figure that I didn't include in my slides, which is there should be a overconfidence score and uncertainty of score here. Oh, here. Okay. Let me show you the asset growth premium ranked by individualism. So the countries to the left is the most collective country. So if you can see it, Indonesia is all the way to the left, meaning that in the survey, Indonesia is the most collective countries that have been surveyed. And not surprisingly, US is all the way to the right. So the US is the most individualistic countries around the world. I think that's also understandable. So if you can see that the asset growth premium fluctuates a lot among different countries. So for example, for US, the asset growth effect is strongest I'm sorry, not the strongest among all countries. Actually, these are stronger. But because finance, as a finance scholar, the things we're talking about is on average. It's very difficult. People always ask me why there are so many variations, and it's really difficult to explain. But the thing is, if you could look at the different country among countries, the individualism tend to be positively correlated with the asset growth effect. So this is the first impression. This is only it's more of like a univariate test that's visualized that individualism is actually positively related to asset growth effect. So this is what has been established in the literature. And what about uncertainty avoidance? For uncertainty avoidance, the trend is exactly reversed. So let me see if I can find Indonesia here. Sorry. Oh, here. Indonesia is somewhat to the left, meaning that it's tend to be more uncertainty avoidance than the countries to the right. Okay, and the country that's the most uncertainty avoidance is Singapore, and Greece is on the other side. So these are the national cultural aspects that have been derived from previous surveys. So as you can see here, the trend for individualism and uncertainty avoidance are exactly the opposite. So this is the first evidence that support our hypothesis. But of course, this is not good enough because we also need to show that the results will hold in a multivariate setting. Let me go back to my slides. Okay. All right. So okay. So this is the univariate test that the first set of tables, and I try to summarize here that we have equally weighted returns and value weighted returns. The results are similar, so I'll focus on value weighted returns. So what you can see here is for low individualistic countries, the AG1, which is the firms that have the least asset growth rate, okay, that have invest less, or straightforward, these firms invest less. And these firms, AG10, those are the firms that invest the most. So we group firms into deciles. Those invest least and those invest the most. So those invest the most tend to have higher returns, but those invest the least tend to have relatively lower returns. This is in contrast with the literature findings, but remember, these are for low individualistic countries. So for firms that are in high individualistic countries, that actually firms invest more tend to have lower returns than firms that invest less. So the difference is positive. If you take the difference between AG1 and AG10, the difference is 0.633% per month. So this is statistically as well as economically significant. So what we try to show is this number in red. This is somewhat like difference in difference tests. So we have difference between AG10 and AG1 and try to be certain that the asset growth effect exists. And this only exists for high individualistic countries. And the difference between high individualistic countries, the asset growth effect between high individualistic countries and low individualistic countries is 0.745% per month. And again, both statistically and economically significant. So if you would like, you can focus on the number to the lower right. This number indicates that firms that are located in high individualistic countries, they tend to have higher asset growth effect or more significant asset growth effect. So this is the first set of results that showing the asset growth effect is actually stronger for high individualistic countries. And what about uncertainty avoidance? As I said, for uncertainty avoidant countries, this is the uncertainty avoidance index, okay? So this uncertainty avoidance index, what you can see here, let me take this high individualistic country as an example. As you can see here, for firms that are more highly uncertainty avoidance, okay, means that those firms, the managers tend to invest not overconfidently. So the AG10 is actually higher than AG1. This is the reverse of asset growth effect. So firms that are located in high uncertainty avoidance countries, they're, well, I hate to say they're more rational because we're not talking about rationality versus irrationality. But the thing is, the asset growth effect is reversed, exactly the opposite to overconfidence. So if you take the difference between low uncertainty avoidance countries and high uncertainty avoidance countries, then the difference will be negative 0.692% per month. Let's put it in economic terms. Managers in low uncertainty avoidance countries, they tend to not overinvest. So when they invest more, the asset growth effect is not strong, or even they can be reversed. Okay, so this is in contrast to the individualism and asset growth anomaly. Okay? So these are the two basic results, and of course, these results are not good enough. We need to do a series of robustness tests. So We exclude the US market data and the results are similar. We also partition our data by 1999, which is about around the time right before the internet market crash, internet bubble crash, and also it's about half of our data period. So the results are again similar. And also we calculate returns in local currency terms, and the results are similar. Okay. And next, we future evidence on the overinvestment hypothesis across countries. So again, I'll focus on this value-weighted returns. So what you can see here is okay, let me explain why we have this set of table first. And from the literature, as it has been pointed out that firms with low debt ratio tend to have more discretion in. So in other words, firms that have low debt tend to overinvest. So the asset growth will be strong firms that are less levered or have less debt. And this is exactly what we find. We separate firms into different leverages. So firms that are lower levered, the asset growth effect is stronger. Okay, is stronger for individualistic cultures or individualistic countries. For uncertainty avoidance, the results should be reversed. The returns should be reversed. So the returns are negative, which is in the right directions, but the results are not as strong as individualistic culture factors. So we still find that the low debt ratio and medium debt ratio firms, they tend to have stronger asset growth effect, but it's not the strongest for the lowest debt ratio firms. So again, overall, the results are still there, just not that it's not a monotonic relationship. Okay, so again, lower debt firms, medium debt firms, low debt ratio firms, they tend to have more significant asset growth effect. And this is consistent with the hypothesis in the literature. So let me summarize the previous results, okay, before I go one step further. So basically, firms in individualistic countries, they tend to overinvest and the performance are going to be worse because they invest inefficiently. But for managers with more uncertainty avoidance, they tend to overinvest less, or they tend to invest less. So the asset growth effect will be gone or even be reversed, okay, in the exact opposite to what have been found in literature. So in our previous results, these are actually the main results that most significant results we can find, and they are consistent with our hypothesis. The first hypothesis is individualistic firms, they tend to have higher asset growth effect, and uncertainty avoidant firms, they do not have a strong asset growth effect, where the strong asset growth effect can even be reversed. Okay, so these are the major results. Okay. And next would be Farmer-Macbeth regression. Because for previous results, we separate firms into deciles, so group firms into deciles. So in this table, we use the continuous variable. This is the one plus, on the first variable is one plus the total asset growth rate. So the hypothesis would be this: firms that have more growth or higher growth in total asset, their future returns tend to be negative, especially for high individualistic countries. And this is exactly what we find. Okay, so again, this is consistent with our previous hypothesis. Okay, and for uncertainty avoidance, again, in high uncertainty avoidance countries, the asset growth effect will be less significant or even be reversed. So the difference is positive. Okay, and in low uncertainty avoidance countries, the asset growth effect is still very strong. Okay, so these signs and the significance are all consistent with our first two hypotheses. And next, we add a bunch of different variables, other factors from the literature, trying to show you that our results are robust to other possible explanations or alternative explanations. So we took market development variables from Tipman, Wei, and Shi 2013, including market development, access to equity market index, market cap to GDP ratio, and ratio of value traded to GDP. So all these variables are related to market development. And we also bring in some market efficiency variables, for example, stock return synchronicity, importance of stock market, and future earnings response coefficient. So all these variables are well established in the literature. What we did here is just try to include those variables that have been proposed in the literature. So it's more like a horse race, okay? If you want to look at that way, it's like a horse race between our variables or our proxies with the proxies that have been proposed in literature, and try to see whether our variables add marginal explanatory power to the asset growth effect hypothesis. I apologize for the small font of the table, but you can only focus on the coefficient that are highlighted. So these are the univariate regressions. Okay, so we put in these variables one by one first. Okay, try to see which variables have more explanatory power. And what we find here is whether it's equally weights or value weights, our individualistic and uncertainty avoidance index are all very significant with the consistent signs and the significance. So these again support our first two hypotheses. And if you put in different variables in a univariate regression framework, some of the other variables are significant and some of those are not, okay? And let me focus on the value weighted portfolio here on the bottom, on panel C, okay? So these are the multiple regressions. So what we did here is we use our individualistic variable and uncertainty avoidance variable together with other variables one by one. So the takeaway from this table is our two proxies are almost always significant with the correct signs, but the other variables, their significance or disappear. In univariate framework, for example, equity obtain positively significant coefficients, but when they are put into our putting in the regression together with our two proxies, the significance of equity is, has all but gone. So this again, shows you that our proxies, national cultures proxies are very significant in explaining the asset growth effect across different countries, right? So this is the market development variable. And we also control for a bunch of other variables from literature, okay? So these are more related to market efficiency. So for example, this is trading cost, idiosyncratic risk, dollar trading volume, whether stock market can be shorted. This is a credit, let me remember. This is creditor protection, and this is the anti-director clause, and this is, what's this? This is, can't remember, I had too many variables. This probably the, let me figure out if from the paper out. If you're interested, I can flip into the paper and talk about this later. But these are all the efficiency, market efficiency proxies. So this is accounting quality. This is the legal origin, whether the firms are located in UK origin, France, the legal origin, Germany, or Scandinavian law origins. So this is earning management score, I remember. This earning management score. So all these are related to market efficiency of a certain country. So in the multiple regressions, some other variables are still significant, but the thing I would like to point out is that our individualistic measures and uncertainty avoidance measures still obtain significance and incorrect signs. Okay, so conclusion is actually simple. We establish a significant linkage between national cultures and asset growth effect. So we propose that overinvestment as a underlying channel. So asset growth premia are significant in countries with high high individualism and low uncertainty avoidance. So let me repeat this again. Managers in high individualistic countries tend to overinvest. So when they invest more, their stock price perform worse. And similarly, managers in low uncertainty avoidance countries, they also tend to overinvest, and their investment results are reflected in stock returns. So their stock returns are going to be perform worse, okay, because they tend to overinvest and they are low uncertainty avoidance, low uncertainty avoiding. Now, finally, so we find that the national cultures dominate other proxies for Q theory and limits to arbitrage in explaining the asset growth anomaly across countries. So, put it simply, because there have been no studies trying to bring together asset growth effect and national cultures. And personally, I'm very interested in how national cultures would affect the corporate decisions and investor decisions. So in my own opinion, I think this is a very interesting work. And of course, there are other things that we need to do. So for example, we haven't clearly established the link between national cultures and investment, the amount of investment. One way to do it is to follow Momentier and Tate try to test whether overconfidence will affect the cash flow and investment sensitivity across countries. So the hypothesis is simple. Firms that are located in more overconfident countries, they tend to invest when they have cash, and they tend to invest more when they have cash. And then they tend to invest less when they have less cash flow. And this is due to overconfidence that have been shown in Momenti and Tate. So we haven't really clearly established the first link. Now we are talking about a bit more indirect link, the link between national cultures and stock returns. But what we can do next is to try to link the national cultures and investment or overinvestment itself. Then that will make our paper more complete. But we're really happy about the results that we're getting so far. Okay, right? So I think that's pretty much I would like to share. Thank you, John.
Thank you, Robin. It's an excellent piece of work by Cho, Ko, and V. You have three co-authors here, and I think we'll open the question and answer session to
Okay.
224
Two,
attendees right now.
okay.
So let me see here. Okay, so I'll take the first question by Rita Juliana.
Mm-hmm. I'm reading it.
Yeah, you're hitting it also.
Okay.
So according to the Hofstadter UAI data, US has lower UAI, but we can say they're more towards overconfident. Do you also find that the US
Okay.
asset growth also is also higher
The firm
than
should
that in other
be
countries?
okay. Uh, Let me bring up my paper
Mhm.
again. So, okay, just a minute. Yeah. Okay. Uh, this is what I said. Because it's really difficult to pin down the result to a single factor. So, for example, if you look at this figure, the U.S. The individualism index of US is all the way to the right. So this is consistent with our general perception. But the thing is, the asset growth effect is not the highest in the US. It's actually, if you look at this figure, I think it's the highest for India. So people always ask me the question, as I said, a few minutes ago, and why would there be so much variation among different countries in terms of asset growth effect? Uh, the answer would be because it's really difficult to control for other relevant factors. So this is a shortcoming of the paper, I would say, but it also opens up a lot of research opportunity for future researchers because There are so many variations. It's really difficult to pin down to a certain or a set of few factors. So there are so many other factors that we haven't known now. So we should we should, if for those who are interested, this is you can see this as an opportunity for future research. Try to figure out what are the other relevant factors that would also is an anomaly or not. Okay, so in this paper, we're not trying to say whether it's anomaly or whether the effect is rational or irrational. What we're trying to do here is to show you that we find two additional factors that have significant explanatory power over asset growth effect. So I intentionally use the word effect instead of anomaly because an anomaly is controversial, right?
Mm.
If you think it is, then it is. But people also think, there are some researchers, they think that asset growth effect is actually rational because managers invest when the future expected return is low or the future cost of capital is low. So that's the part we're not trying to, jump in because it's very controversial. But what we're trying to say in this paper is that national cultures are well researched in the literature, but there have been no study linked national cultures to asset growth effect. So we would say, well, let's try it. But as I say, the paper, there's something missing in this paper because we haven't really tested whether the whether the uncertainty avoidance index and uh, the individualism index are actually related to overinvestment itself. So that's the thing we're trying to figure out now, and we're working on it. So if we can establish the first link and the second, the relation between asset growth effect and national cultures will become naturally understandable. Okay. I don't know
Thank you,
whether I
Robin.
Can I ask a
Uh,
question, please,
yeah.
Pak Eddie?
Okay. Yes. Yes,
Yeah.
sure. Professor
Okay.
Kandulili.
So I just want to ask first about the you on two national cultural dimensions.
yes,
The
yes.
first, why only two? Because I think you take from the Hofstede, right?
Yes.
The national cultural
Mm-hmm,
Hofstede.
mm-hmm,
Because we also have like a power descent, femininity, and masculinity, right?
mm-hmm.
For the
Right.
cultural, national cultural dimension. Is the first
Mm-hmm,
questions.
mm-hmm,
Why you only choose two dimensions?
mm-hmm,
You have some reason. The second one, uh, individualism countries, they tend to have over investment, right?
mm-hmm,
And the also the less uncertainty avoidance
mm-hmm,
cultural dimension will tend to have over investments.
mm-hmm, mm-hmm.
Okay, if we just try to relate to the because the over or under investment is related also to the agency theory, right?
an opportunity for Inge to ask a question. Please, Inge. Is Inge here?
Maybe you just read by ID because maybe they cannot.
Yeah, there's no
hear.
more question from the Q&A chat room, but
Okay.
some people have raised hands. No, Inge, then I will continue with Idam. Yes, Idam Lakoni.
Actually, there is a question in the Q&A.
Okay.
Oh yeah, just came up.
Please answer some firm that the last risk taking.
For attendees who wish to ask question,
Yeah.
please refer to the Q&A chat box so you can type your question there and then get it answered by
That's
Prof.
right. Yeah.
Robin.
I mean, some
Thank you.
people raised hands but didn't want to talk this question. So by Eddie Gunawan, a question by Eddie Gunawan. He has thought
Okay.
that the
Less risk taking,
paranoia.
low uncertainty will actually tend to overinvest. Yes, that's what's found in our paper. But Eddie was thought the opposite because paranoia or voting risk will make the firm overinvest. I don't understand. Avoiding risk. Now, if you're avoiding low, okay, if you're low uncertainty avoiding, you'll be actually more willing to take on risk, right? So you're not avoiding risk, you're taking more risk. So if you're taking more risk, then you tend to overinvest, and the investment will tend to be unsuccessful. And this is the behavioral bias coming in, because people just don't learn from past experiences. That's why the behavioral bias will still be significant, right? Okay, so sorry, I mean avoiding uncertainty.
Oh,
Yeah, right.
uncertainty avoidance.
Yeah, uncertainty avoidance index is okay. When uncertainty avoidance index is higher, that means you are more uncertainty avoidance, right? So if you are more uncertainty avoidance than avoiding, then you tend to invest less because you're just risk averse, okay? So if you invest less, that's actually good for the firm because you tend to invest more efficiently, and the tendency to overinvest is mitigated. So that's why the asset growth effect for uncertainty avoidance index is exactly opposite to individualism index. So let me show you the results again. I don't know whether it's probably okay. Let me show you the slides again here. Okay. Let me explain this again very quickly. This is the individualism. So what you can see here is for firms that are in high individualistic countries, okay, the AG10 are the firms that invest the most that experience lower returns. So the difference will be positive, right? And the difference in difference will be positive. These slides talk about the difference between high and low individualistic firms. So as you can see, 0.745 is the difference between high and low individualistic countries. So the asset growth effect is very significant for high individualistic countries. That's the basic conclusion here. Now, for the next slides, the results are exactly the opposite, right? For low uncertainty avoidant firms or countries, firms in those countries, when the firms invest more, they experience less return or lower return. When they invest more, they experience lower return. When they invest less, they invest more efficiently. But the thing is, the important point to take away from this slides is the difference between high and low uncertainty avoidance firms. You can see here the results are exactly the opposite to individualism. I'm sorry, there's a typo here. This should be this is UAR. I'm sorry about that. I didn't change the title. This is uncertainty avoidance index and asset growth anomaly. So the basic idea is that individualism and uncertainty avoidance work in the exact opposite way. And it's a bit confusing when you look at this UAI. The way to think about it is that for firms located in low uncertainty avoiding countries, the asset growth effect is stronger, or the strongest, right? It's in the contrast to firms that located in high uncertainty avoidance firms. In high uncertainty avoidance firms, the asset growth effect is not significant. So this is exactly the opposite to individualism results. Okay? So I don't know if I explain things
Yeah, I think
clearly,
yes,
but
it's quite clear. Yeah. Thank you, Robin. I think he has a continuation to the previous question. But I think
okay.
he has another perspective, like he's thinking that the uncertainty avoidance, like when he doesn't like uncertainty, he would overinvest. I think this is like an exception or a particular situation because he's thinking otherwise.
Mm.
Like people
Mm-hmm.
with higher uncertainty avoidance will tend to overinvest. I mean, maybe it's not common. Also, it doesn't fit to my
Okay.
a common thought, but maybe there's an exception or spectacular situation
Yeah.
that makes people
Okay.
to be like
Okay.
this.
That's I don't know. Intuitively, I
Yeah.
would say if you're low uncertainty avoidance, that means you can take on more risk, so you tend to invest more.
Hmm.
That's my
Mhm.
perception. But I don't know.
Yeah,
Maybe
that's common perception.
we need to
Yeah.
establish the link. As I said, we need to establish the
Mm.
first link that we haven't done yet.
Mhm.
We need to actually test the link between
Mhm.
individualism and UAI and overinvestment first, and then we can carry on with our stories. So now it's like we jump to the
Yeah.
second part of the story without clearly show people that the
Mm.
first link is there. We only rely on the literature, and that's
Right.
true. You can always criticize
Yeah.
that you didn't really show the
Uh,
clear results or evidence on why UAI and individualism are related to overinvestment. Yeah, we'll take that criticism. Yeah.
Thank you, Robin.
Robin, maybe yeah,
Yeah.
okay, Eddie. Just I want to add
Yes.
little things, right? Like the country with the you know high uncertainty avoidance or maybe low uncertainty avoidance.
Mm-hmm.
Okay, and how about if the manager is overconfidence? What do you think?
So, say it again, please.
The manager are
Mm-hmm.
overconfidence.
Mm-hmm.
Do you think that it's also affect the because we study also about the overconfidence
Mm-hmm.
of the managers, right? And the overconfidence tend to also have the over investments. So what do
Yeah,
you think when you are studying?
that's what we're trying to propose. If you're overconfident, then you tend to invest more, right? Because you're pretty sure that your project will be successful. So in the literature, the model that have been proposed in the literature is that the overconfident managers, they usually overestimate the successful rate of their projects and the expected returns, future expected returns of their projects. So that's why they are more willing to take on new projects or even merge with other firms. So Momenti and Tate in two papers they talk about overconfident managers. They tend to invest more and tend to initiate merger acquisition deals more frequently. And if they start merger and acquisition deals, the probability of getting it done is also higher for overconfident managers. Okay.
Okay, thank
Okay.
thank you.
Yeah. Thank you, Robin.
Yes.
The next one, I'll give a chance to Daisy. Daisy Femilinda Safitri. She raised her hand.
Miss
Yeah, please
Desi,
unmute
please
yourself
unmute
and
the microphone
yeah.
to give the question.
Yeah, so nothing. So
Maybe because they cannot
yeah.
unmute, right, Yolanda? Because I think
Yes,
yeah,
yes, they
because it's
can,
already
Prof.
said. already
They
set
can.
by the admin, right?
They
The
already
host.
they're able to
They're
unmute
able.
the
Okay, so
microphone.
they're
Yeah,
able,
Yeah,
right?
we
I
have changed
enable.
the
Yeah,
setting.
I enable it.
Yeah.
I enable it. Yes. So maybe from other panelists, if you have questions to
Uh,
Robin,
can
we
I go
still have
back to
some maybe 10 minutes or so.
Eddie's last question?
Yes,
Okay. Eddie says
yes,
that if I
yes.
don't like uncertainty, so I overinvest to avoid uncertainty. I think that's the opposite because all investments are
Mm,
risky, right?
mm,
So the
mm.
safest, if you don't like uncertainty, then you'll keep your money in closet. That's the safest way to guard your money, right? So
Yeah,
every investment would have risk. So if you don't like risk, don't invest. That's the idea.
that's right. That's right. That's right. Yeah, that's right. But I think what you explained was very important. I mean, if you have the test, the preliminary test
Hmm.
that shows the relationship between the investment itself with the
Right,
national cultures, then that will
right.
prove everything. There will be no
That's
more,
right.
debate on this one. Yeah, this right.
Yeah, yeah, John, you're right. So that's what I said. The first link is
Yeah,
missing, so it always brings a lot
yeah,
of questions. Why,
yeah,
but the problem is that investment data is somewhat difficult to obtain, and the Momentian paper, they don't directly look at how overconfidence would affect overinvestment because overinvestment itself is very difficult to define. What's over, what's under, what's just right. It's really difficult. So what they did in their paper is to look at how overconfidence would affect the cash flow and investment sensitivity. Because from theory, investment and current cash flows should have no relationship, right? Because if you have insufficient cash, you raise capital to invest in positive NPV projects. Now, if you have a lot of cash, you don't invest in negative NPV projects because you have too much money, right? So theoretically, current cash flow and current investment should have no relationship. But what's found in the literature is that current cash flow is highly positively significant related to current investment. So that means managers try to invest more when they have more cash and try to invest less when they have less cash. And why is that? Because if you don't have enough cash and you are overconfident, you don't like to go to the market and raise capital because you always think the cost of capital is too high, right? Because you have confidence in your firm. So you always think that the cost of equity capital and cost of debt capital is too high for your firm because other people don't understand you're so good at managing. So you tend not to raise capital when you don't have cash. Now, what about if you have too much cash? Then you tend to overinvest, right? Because you're overconfident yourself in your own ability. So when you have more money, you'll be more willing to invest when you don't have money, you would be hesitate to raise capital outside capital, so you invest less. So overconfidence is probably a driving force between the sensitivity of cash flow and current investment. So what I'm trying to explain here is that even Momentian take in the their paper, they didn't go on the track of directly testing overconfidence. Instead, I'm sorry, overinvestment. Instead, they test the relation between cash flow investment and how the sensitivity of cash flow investment is related to overconfidence. And I find there's a clear link between overconfidence and the sensitivity of cash flow investment. Okay, so story is a bit long, but to put in short, that's the first link that's missing in the paper, and certainly we'll try to amend it and
yeah.
put it up.
Mm.
So the
Thank
more
you, Robin.
questions.
And actually, yeah, actually, we have one more
Mm-hmm.
question from Mayang Dewi Indrawati.
Okay.
She's saying, do you think the research results will portray the index or indexes of stock exchanges in different countries? And do you think one of the anomalies on your research is the government policy factor?
Okay, the first question is, do you think the research result will portray an index of stock exchange in different countries? I don't really understand this question, but if you're talking about the index of stock returns among different exchanges, uh, then you would you wouldn't be able to test the asset growth effect because for asset growth effect, you need to have firm level data. But if it's a market data, you don't have uh, it's not, it's impossible to distinguish between returns among different firms. So, but if you're talking about whether national cultures would affect returns of different stock markets or stock exchange, then that's possible. But I don't know how to test it. You probably want to come up with hypothesis first. So, for example, one thing comes to mind is that is it possible that uh, countries that are more individualistic, then their stock markets tend to fluctuate more or tend to be more volatile? That's possible, you know, because in Taiwan, we're always joking that Taiwanese people like to gamble. So the stock markets fluctuate a lot. So if you want to come up with something like that, I think that's interesting. But for firm level data, I don't think that would work. As a growth effect, that won't work on the stock exchange level. Okay. And the second question is, do you think one of the anomaly on your research is government policy factor? I don't really, uh, I don't fully understand what you refer as a government policy factor. But if you're thinking about like tax law changes or dividend law changes, that's possible. But that's more of like a exogenous shock to the system. So if you think the research has some sort of endogeneity problem, then government policy factor is always a good event because government cannot be, well, is less likely to be influenced by firms, and government policy would affect firms very significantly. So for the asset growth effect, I haven't seen any paper talking about government policy. But if you want to, you know, give me a few examples about what kind of government policies you're talking about, then I can probably, get back to you with more of my thoughts. Okay.
Thank you, Robin. Maybe in some situations, um, I mean, I'm trying to interpret what Mayang tried to say. I mean, maybe in some countries, um, they have like certain ethnic cultures
Mm-hmm.
or more natural cultures, but because of the national systems which are contrary to the national cultures,
Mm-hmm.
the people might behave differently. We
Mm-hmm.
could say, for example, the between the South and the North Korea.
Mm-hmm.
North Korea are Koreans, Asian people, but because they're using more extreme type of socialism, maybe
Mm-hmm.
they behave differently or something. But maybe this is an exception as well, like what AD Gunawan
Okay.
tried to ask as well. But what do you think about that?
You mean the Eddie's new question?
I mean, Mayang, I mean, from
Mm-hmm.
what I interpret Mayang's questions,
Mm-hmm.
maybe she's observing that there are some countries with certain national cultures, but they behave differently because of national
Mm.
regulations or national policy in general, like socialism or
Okay.
something.
Okay. Maybe.
Maybe that could happen.
Yeah,
Yeah.
that could
So,
happen. So the
mm,
government
mm,
policies or government regulations could be additional controls. And
yeah,
what we
yeah.
have in our paper is legal region. That's
Mm,
pretty close to
mm,
what you're talking about. But yeah,
mm,
as I say, it's the idea is actually very interesting. As I show you the figure, there's so much variations in asset growth anomaly among different countries. So our factor can only capture some of them, but there are still a lot of other things that you can come up with and potentially can explain the asset growth effect in an international setting. So government policies would be, possible factor, but I don't know yet. Yeah.
Thank you, Robin.
Yes.
Maybe one more question, if any, before I wrap it up.
I think Eddie has another question. Did you see it?
Uh, yeah,
1109.
the previous one. I think this was again a continuation
Yeah.
to his previous ideas. So
Okay. Yeah. Let me reply shortly. I mean,
yeah.
the thing is,
Mm,
I think
mm,
the example that you give is not exactly what we're trying to figure out here because we're talking about capital
mm,
investment. So, for example, firms will will invest in capital projects to make profits, not to protect yourself, right? So, I think the basic idea is a little bit different. You invest to make profits. So, all high risk, high return. That's in finance terms. So no risk, no return, low risk, low return. So the example that you're giving is to invest in protective instruments. That's not what I'm talking about here. Okay, that's a different. I think that idea is interesting, but it's a different topic, I would say. Yeah.
Mm. Yeah, thank you, Robin. Yeah, I think what Eddie is saying also shows that the nature of research is about
Yes.
generalization. There will always be some
Mm-hmm.
exceptions, some different thoughts or some different
Mm-hmm.
practices every now and then. But again, the nature of research itself is to generalize. I mean, we talk based on data or based on I think the majority of cases or
Yeah,
situations.
that's right.
So
That's right.
that's
Yeah.
very interesting.
Thank
Yeah,
you.
yeah. Thank you,
Okay.
Robin, and
Thank you
thank
so
you
much.
to all attendees who have asked questions, who have raised hands but didn't want to talk. But so thank you very much to all of you, to all the panelists as well. I think I'll hand it back to Tantiana. But again, thank you for this previous this uh,
Mhm.
privilege that we could see Robin, Professor Gondry, Professor Edward, Professor Irwan, and all the panelists and attendees here.
Yeah.
Thank you, and see you next time.
Thank you
I
so
Yes,
send
much.
it back to Tantiana.
Hopefully we'll see you in
Thank
person
you.
next time.
of
Sure.
course.
Okay.
Yeah. Take care.
Okay. See you. Bye bye.
All right. Thank you so
Bye.
much for Mr. John Eddie Junarsin for moderating, and also for thank you for Prof. Chow for presenting your research. I'm sure that it has given interesting insights to all of us in the conference here today. And after this session, we're going to have IFA session first, and then continue with break. And after that, we will have parallel sessions as scheduled on the guidebook provided. So for the IFA session, please welcome the board of IFA. Probably Prof. Ted will start.
Okay, thank you, Yolanda. Maybe I will show my slide first, right? Let me okay. Can everybody see the slide?
Yes.
Okay, so this is I just want to uh, show you the journey of Indonesian Finance Association so far, right? So okay, this is the Indonesian Finance Associations, right? This is the non-profit organization established to cultivate a strong networking among academics, business, regulator, and financial expert in Indonesia, especially in the realm of corporate finance, capital market, international finance, and financial institutions. So in this session, I will, discuss with all participants and also all speakers, and maybe some of you already become a members of Indonesian Finance Associations. Okay, if you still not a member, and officially today you are become a member, because automatically when you join the IFA conference, and you are become a member of Indonesian Finance Associations. Next, okay, this is the Professor Iwan as a president, and I'm a chairman or chair of the advisory board. Okay, and also we have Irwan Triguno from Universitas 11 Maret as a vice okay president of the program of international relation, and also Mamdu Hanafi, vice president for membership and administration, and the last one, vice president for research and activities and cooperations, Dr. Safri Husodo. Maybe I just want to mention Mamdu Hanafi just got the professorship, right? So now it's become a Professor Mamdu Hanafi. Okay, and you can see here, actually IFA was initiated by three business school in Indonesia from Universitas Indonesia, Faculty of Economics and Business, from also Universitas 11 Maret, and of course from Universitas Gadjah Mada. Okay, so at the time, I think back in 2015, okay, we meet several times and we decide to establish the Indonesian Finance Associations. Okay, and this is a non-profit organizations. So we are happy to invite all the academicians, professionals to join these Indonesian finance associations. Okay, so sorry. Okay, so the first IFA first conference in 2015 hosted by Faculty of Economics and Business, Universitas 11 Maret in Surakarta. Is very close to Yogyakarta, actually only 1 hour from Yogyakarta. And IFA second conference held in 2016, hosted by Faculty of Economy and Business, Universitas Gadjah Mada, here in Yogyakarta. And the third conference, sorry, this should be 2017, hosted by Faculty of Economics, Universitas Indonesia. And fourth conference in 2018, hosted by Faculty of Economy, Universitas Lampung in Sumatra. And the fifth conference in 2019, hosted by Faculty of Economics and Business, Universitas Samratulangi. This is in Sulawesi, North Sulawesi, far from Yogyakarta. It's about 3 hours flight from Jakarta to Universitas Samratulangi in Manado, North Sulawesi. And of course, today conference, sixth conference, sorry, this should be 2020, right? 2020, hosted by Indonesian Stock Exchange like we have right now here. Okay, so, okay, we hope that every year we will have a conference and we will invite all the academician and professional to join the conference to present their paper so we can exchange, right, from the academician and from a professional practitioner, right, to come together and share our view about that what happened in the theory side and what happened in the practical side. So this is actually the main. So in this meeting, I hope that maybe, right, everybody can share or maybe give some suggestion what actually we want, okay, the IFA, right, in the futures. So can help or also contribute to the academician and also to the professional. So our mission is enhancing Indonesian financial scholar contribution to international academic landscape and participating in advancing the financial literacy and policy in Indonesia. Our objective, fostering the networking among members, promoting its members' experience and personal development, and improving knowledge in financial field. And of course, we also hope that we can, have publishing in top tier journal based on robust and religious methodology for our paper. So this is actually about the mission and the objective of Indonesian Finance Associations. Okay, and this is just a documentation of some event that we already held before, right? So start from the first in Universitas 11 Maret, and the second in Universitas Gadjah Mada, the third okay in Universitas Indonesia, the fourth Universitas Lampung, and the fifth Universitas Samratulangi, and today of course hosted by the Indonesian uh, Stock Exchange. Okay, we have a problem at the time, right, when the COVID come, because we have two choices. First, we want to cancel the program, or we still continue. Okay, but finally we decide to continue, but we change from a physical, uh, 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 come together, right, and meet together physically, but we decide to have the online conference. So that's why today we have a online conference. So this is actually we can see from a previous event that we already have. So now I invite everybody, if you have any suggestion for Indonesian Finance Association, we have about 1 hour before we break for Friday prayers, okay? Because today Friday in Indonesia, so we will finish 11:30, okay, for these sessions. We call the IFA sessions, okay? So this is also for the networking. If you have any suggestion, question about the Indonesian Finance Association, I'm very happy to to answer. Okay, and also here I invite some of the board members. Okay, and also Pak Mamdu if here. Okay, Pak Safri and Pak Irwan Tri, and also Pak Irwan Ekaputra of course have uh, program with the LPS, right? Indonesian Depository Agency. Okay, so if you have any questions, so I just maybe so I can see everybody. Okay, so now please, if from all participants presenter, if you have any suggestion also about the IFA, so we can maybe improve and serve more to the members, right? From the board, from maybe I can also give some. We have a secretariat in Yogyakarta. Okay, we have a secretariat here in the building of our Master of Management program in Yogyakarta. We have one rooms, and also we have one secretary to serve you. So if you have any question, or if you want to know something, and if you want to have a membership certificate, you just contact us. We will send you the electronic membership certificate. Okay, all everybody for free, because now we want everybody to join, and later on maybe you have to pay a member fee, right? But right now we still have no member fee. Okay, and we can run this organization, okay, because after the conference we hope we have some money left, so we can use the money to run the organization, because we don't have other income so far. We don't have other income. Just when we have a conference, usually after we finish the conference, we hope that the money that come from the sponsor, we still have left some money, and this is the money we use for run this program. Okay, so this is about the IFA. So if you have any suggestion, please.
If anyone has any suggestion, probably
Yeah.
they want to raise their hand, and then we will let them speak for the conference. Or maybe other board members would like to say something, Prof. Ted?
Yeah. Maybe from a board member is here. Okay, please. Irwan still here or already joined the LPS? I don't know.
Still here. I'm joining both actually.
Okay, both. Okay, Pak Irwan,
Parallel.
if you want to say something, yeah, the president.
First of all, I would like to say thank you for everybody for joining this conference. As Prof. Ted already mentioned, that you will be automatically registered as the member of the IFA. But probably if we forget if you need your certificate, please email us, and we have a person who is in charge for that is Mbak Anissa. I think she's in the, I don't know whether she's in the panelist, but I saw that she has sent some
Yes.
messages through the chat. And probably Mbak Anissa would like to create some list through certain link so that the new members can register, and probably also share the email of IFA email, whereby if anybody wants to get a certificate, they can just email us. Yeah, your support means a lot to us because this organization is from us all and for all of us to enhance our finance capabilities as for academics as well as for the real sectors of the businesses, and also for the networks between businesses and academics. I think that's, for me, that's all for now. Thank you.
Thank you, Prof. Irwan. Prof. Ted, there is actually a question from the Q&A box.
Yes.
Is there any plan for the next conference? The host, who is the host of the conference? Who's gonna be the host? Do you have any plans, Prof?
Yeah, we haven't decided yet because usually some university they will send us the proposal that they want to be a host for the next conference, right? But until now we haven't decided. Of course, there are some proposal already. We already have, but we haven't decided yet. Okay, even this morning, Pak Irnano mentioned that let's make it next year again in Bursa Efek Indonesia, right? Okay, Pak Irnano said, but let's see because we still at the time, okay, before COVID, of course, we already prepare everything that we will have a conference in Bursa Efek, right? So everybody can come in the Bursa Efek Indonesia in Jakarta, Jalan Sudirman. But unfortunately, the COVID come and we have to decide, right? Have a conference to the online, right? So maybe next, yeah, we haven't decided, but maybe if the conditions become better when the COVID-19 pass, and maybe we can come again to Bursa Efek Indonesia and meet there, because we already discussed about the room, we already prepare everything actually, right?
Mhm.
But we don't know, right? Suddenly the COVID come and we have to decide, right, to have this kind of conference.
That's
Okay,
true.
so we haven't decided yet. Okay.
Okay. Thank you, Prof. Ted. Actually, Miss Inge Barlian has been promoted to panelist. Maybe you can unmute and turn on your video to ask questions or probably have some networking. Please, Miss Inge Barlian. Hello, Miss Inge. Are you there?
Yeah,
Maybe
I think
she's
it's
too
still
shy.
yeah, we okay, no problem, right? If you feel convenience to speak in Bahasa, doesn't matter, right? Doesn't
That's
matter.
true. Yeah.
Yeah. Okay, because this is not our language, don't worry about that.
Mhm.
Because whatever I attend the other conference about usually also the same things, right? Okay, so please, if you feel more confidence to speak in Bahasa, please don't worry about it. Okay, Pak
Okay.
Edi Gunawan, I think is
Wait.
I don't
Let's
think
see.
I think from the host maybe I mean they cannot unmute. Yes, still
We have
unmute.
Yeah, we
already
enabled it. Yeah,
yeah,
we
we
enabled
enabled it
it.
already.
Yeah, they
Mm,
unable, right? Yeah,
mm.
because so far it's difficult for me to hear from them. Okay, please let's see in the chat, yeah, in the chat what they say in the chat room.
Yeah, maybe Eddie Gunawin.
Would like to say something probably.
Yeah, Edi Gunawan, you have a lot of questions. Please.
Okay, we're going to promote him. Okay, already. Okay, maybe
Yeah,
you can
okay,
turn on your
yes, it's
video.
working. I just want to try to
Sure.
see whether you can, whether the attendees can unmute. So
Yeah, you
it's
can.
working. Yeah, that's okay.
Yeah.
I just want to say that it's a very good conference. I would suggest that, even though we definitely hope that the COVID will pass, but in the future, the conference should also have the online version so
Yeah.
that people who cannot travel to Lampung or Surabaya,
Mm,
I would love it if it is in Bursa Efek Indonesia again, because
yeah.
I'm in Jakarta. But if it is, on another city, then at least if you have the online version, then people can join as well. So just a suggestion. Thank you.
Okay,
Thank
Pak
you.
Edi, what's your institution?
I'm actually a listed company. I'm from Super Crane,
Okay, okay.
Mitra
From
Utama.
listed
Yeah,
company.
we are crane rental company.
Okay, thank you.
Thank you.
Yeah, I think it's a good idea, right? Because in the previous conference, if suddenly the speaker cannot come, and usually we just try to use the Zoom or others media, so they can still present their papers, right? I think as a good idea, maybe we can mix, right, between if they can come and also if they can present, like for instance, especially from other countries, sometimes it's difficult, right, to get a visa, and the other thing is also maybe too expensive for them to come to Indonesia. Okay, so I think the good idea, I mean, in the next conference, we can mix. If we already can meet, right? But we still can use the online, presentations. Okay, and also we can use the Zoom. So some of them also maybe can just follow through the online.
Yeah.
Okay, in the futures, I think. Right.
Yeah.
So thank you,
That's
Eddie.
a really good idea, Prof, to
Yeah,
have it both
yeah,
virtual and also physical, probably in the
yeah,
near
yeah. I
future.
think so. Yeah.
Yeah. There is also another question from John Sham. The question is, how is your membership divided between academics and practitioners? As for practitioners, is it mainly bankers or does it include corporates?
Okay, maybe Pak. Okay, the Pak Mamdu is here because Pak Mamdu is the vice president for the membership. But if not here, and I will answer.
Yeah, I'm here, but
Yeah, yeah, Pak Mamdu, can you answer, Pak Mamdu?
uh, we trying to formulate the membership policy. So far, I think the membership is just individual membership. In the past, we thinking about the institutional membership, but so far we haven't activated that feature yet. Let's say this feature. So individual membership. So I think since we want to cover both the academics and professional. So I think we welcome both the academic and the professional. Our main activities so far mostly academic. like annual conference we have today. But in the past, probably we're going to have, or we would like to have collaboration with the professional, because the academic is not going to be in the, what do you call, ivory tower. And then we're going to also go to the field basically. So we like to collaborate with the professional world. But probably since our route is the academic, what is it, the academic community, so probably the academic activities probably still the main activities of the institution, but we like to extend to the professional world. So yeah, I think we will welcome the membership from the professional. I think that's and the policy for the membership keep changing. I think probably in the future, in the near future, we going to set up more formal membership policy as well. This but that we're going to have some discussion on the memberships. So far, our membership is still free membership, so everyone can be membership. Everyone can join this association, and then we welcome collaboration from others, from professional. So let's make this institution, the association is ours, not only us, but ours. Not only
Okay.
me, not only Pak Ted, not only academics, but probably also all people. I think that's yeah, that's from me, Pak Ted. Thank you.
Okay, thank you, Prof. Mamdu.
Thank you so much, Prof. Mamdu. The spirit is there. So the association is actually for everyone who wants to join. And there's also another question from Mr. Berto Usman. He asks if there is any special membership price or discount for PhD or master's student. Prof. Ted.
So we still don't have
Membership fee.
membership fee. So if you want to pay, that's all right. All right.
That's true.
You donate, do not donate something. Yeah, it's okay, right? But,
Donation
so
is
far
all
we
always welcome, yeah, Prof.
yeah, welcome.
Actually, so it's still free, so everyone can join. Maybe Miss Anissa in the chat box has already sent the links for the materials for the conference. So maybe if you want to download or look at the materials, you can go there to the link. And there's also another question in the chat box, Prof. How often the association member will meet? Do you have any routine meetings between the members?
The members actually only once a year, right, during the conference. But for the board members and also small group, usually we have a meeting. Like for instance, sometimes we also have a workshop program, and we discuss about the issues in methodology research, right, especially in finance. And also we will have a workshop for the current issue in finance, right, and we invite, but they have to register, and for this sometimes we have to ask them to pay. Right, because it's not free, right, and the money actually come from these activities, right, so we can run this organization. And maybe I want to add some things, right. If you can see here, we have a logo here, so every institutions or university become a host, automatically every conference will be put the institution or the university logo in our conference. Like we have, in your virtual background, we have Universitas Gadjah Mada, we have Universitas Indonesia, Universitas 11 Maret, Universitas Lampung, okay, and Universitas Samratulangi. and Universitas Surabaya, because as a sponsor also provide us with the Zoom meeting for the parallel session. So we put the logo there. Right? So you can see there, right? If you become a host, and of course the next conference, your university will be there.
Of course, Prof. That.
Yeah.
There is also another question, actually a suggestion from one of the attendees about IFA association. Probably they could have a WhatsApp group, probably for good or valid information about economic issues. Probably there is a suggestion, Prof. That.
Okay, let's see if yeah, because now it's very easy to communicate if we are in the WhatsApp group, right? I already have I don't know, right?
Great.
Countless.
Thousands of group.
More than 30 WhatsApp group, right? Because all like when I have a class in finance, also I ask students
To make a WhatsApp
yeah, to
group.
make the WhatsApp group so I can communicate also easily with the student, I think, right? So let's see, we consider to have the WhatsApp group, IFA WhatsApp group also. So I don't know, for the WhatsApp group, it can be up to how many,
Yeah, there's a limit
and,
on how many members, yeah,
yeah,
in
it's
one
a
WhatsApp
limit
group.
also, right? It's not
Yeah,
unlimited, right? It's the
yeah,
limit also, right?
that's true.
Mm.
Okay. Is there anything other board members wants to deliver or wants to add? Probably we still have a few more. Um, we still
Yes,
have time
actually,
actually.